Hi, welcome back to our video series, Long-Term Thinking. My name is Lon Broske. I'm a certified financial planner with Pines Wealth Management. In today's video, we want to talk about emotions and investing. Emotions, unfortunately, are associated with money. A lot of times with stock market activity, the market goes up, the market goes down, we may experience a wave of emotions. And we talked a couple videos ago about managing your emotions through systematizing your financial plan using the bucket system. Well, today we're going to talk about how investing works and the emotional side of investing and the impact that it can make. But let's look at the Dow Jones Industrial Average. So once again, I'm going to look at history. I'm going to go all the way back to 1897 when the Dow Jones Industrial Average started. If I go all the way back to 1897, Dow Jones Industrial Average that summer closed out at 40. It has never been that low since. Today, the Dow Jones closed out at a little over 41,000. Between 1897 and 2024, that represents over a 100,000% increase in our economy, in those companies that make up the Dow Jones Industrial Average. But let's take a look at some history in order to find out exactly why emotions can be so harmful to your financial plan. When I take a look at every single one-year holding period in the history of the Dow Jones Industrial Average, every single one, doesn't matter, I'll let you pick it out. 1900 to 1901, 1981 to 1982, 2000 to 2001, whatever one-year holding period you want. If I look at the Dow Jones Industrial Average, every single consecutive one-year holding period, I find that 70% of the time the Dow Jones Industrial Average is positive, and 30% of the time the Dow Jones Industrial Average is negative. That's it. I don't care what the economy's doing. I don't care what interest rates are doing. I don't care what the president is saying, what laws Congress are making. It doesn't matter. Let's take a look at every single 5-year consecutive holding period in the history of the markets, going all the way back to 1897. And once again, you can pick out that consecutive 5-year period. 1980 to 1985, 1945 to 1950, it doesn't matter. You have a 92% chance of the Dow Jones Industrial Average being positive and an 8% chance of the Dow Jones Industrial Average being negative. Let's look at a 10-year holding period within the Dow Jones Industrial Average, again going all the way back to 1897. Now the 10-year, you have a 97% chance of being positive and a 3% chance of being negative. That's it. Doesn't matter what Congress is doing or what politics, doesn't matter what the economy is doing. Now let's take a look at the 15-year holding period. If you buy the Dow Jones Industrial Average going all the way back to 1897 and you held it, in other words, you did a Rumpelstiltskin and forgot you even had it. You fell asleep for 15 years. Dow Jones Industrial Average, 100% of the time, the Dow Jones Industrial Average has been positive going all the way back to 1897. There's two things that you need to understand about your investments within your financial plan. Number one, over a period of time, your investments will do this. Second truth is that they will also do this. That is how your investments are going to act. But unfortunately, here's what happens when emotions get involved in your investments. Let's take the name of a company. Let's just say Apple, for instance, okay? Because it's a well-known company. You decide that you would like to invest in Apple. So you decide to buy Apple. Apple's had a fantastic run these last 10 years. And again, I'm not advocating you buy Apple. I'm just using this as an illustration. We decide to buy Apple here, okay? And you're driving home and you're listening to the news and the CEO of Apple comes out and says that we have had a terrible quarter. We're losing money. We're closing locations. We're laying people off. What do you think is going to happen to the value of Apple stock? Absolutely correct. It's going to go down. At that point in time, you decide that I cannot lose any more money. I'm very anxious at this point. I'm fearful. I can't lose it all. Sell it. And that's exactly what we do. And the next day, the CEO of Apple comes out and says, you know what? We made a mistake. Actually, we're making money hand over fist. We're hiring more people. What's going to happen to the value of Apple stock, do you think? Absolutely right. It's going to go back up. And you're going to say, I knew it. I shouldn't have sold, but you're going to buy back in when it's after it's gone back up. Now you can clearly see through this chart here what's happening. You're doing the exact opposite of what you should be doing, but yet the emotions of the moment. Down here at this bottom, that's when the mainstream financial media is in your head. That's when your neighbor is talking to you about why in the world do you still own this dog of a company? Because the emotions at this point in time are too overwhelming. It's going to cause a bad decision. And by the way, here's the second part of this bad decision. Let's say Apple does drop like this, we see here, and we decide that we want to buy Apple. Here's a common reaction that I get. Hey, Lon, I like Apple, but we want to wait until the price comes back up. I'm sorry, what? You want to wait till Apple gets more expensive? The stock market is the only place that I know where people refuse to buy things on sale. Imagine walking into a showroom, finding the perfect new car, and you see that it's $80,000. Nope, I'm not paying that. There's no way I'm going to buy that car for $80,000. You come in the very next week and see that's $100,000 and you go, great, I'll take it. You wouldn't buy your cars that way. You don't buy your groceries that way. You don't buy your electronics that way. Why would you buy your financial future that way? Because of emotions cause bad decisions. The only two truths that we need to know about the stock market is, number one, your investments will do this and they will also do this. When you understand that, that makes you a better investor. And when you're a better investor, you make intelligent, educated decisions within your financial plan. Thank you for watching. If you would like to discuss this more in depth, please feel free to visit our website. You can schedule a consultation there. And thank you for watching, and we look forward to seeing you in our next video.